Good morning, and welcome to today's Moss Adams webcast, Investing Insights, Macro and Markets. Before we begin, I'm going to play a brief housekeeping video.
Welcome and thanks for joining us. Moss Adams webcasts are designed to help elevate your business performance. Transform your future for the better with advisory solutions tailored to your vision and supported by our collective technical resources. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download a PDF copy of today's slides from the slide deck and handouts widget. You can ask our presenter questions during the webcast by typing a question in the Q&A window and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right. Well, good morning, everyone, and welcome to our first webcast of 2025. I am Dominic Cellitti, Senior Financial Advisor with Moss Adams Wealth Advisors, and I'm joined, as always, by our Chief Investment Officer, Michelle Walker. So 2024 is officially in the books. So today we're going to quickly recap what we saw last year, what's going on with interest rates and inflation, how are the economy and consumer holding up, the animal spirits coming back to life, and dig into some opportunities that we like right now. So let's get to it. All right, so let's take a look at how the market did in 2024. All major stock indices were posted outsized returns, with the S&P 500 up a little over 23%, Dow Industrials up 15%, the tech-heavy NASDAQ up a whopping 30%, the S&P 600 small cap lagging, but still up 9%, and the aggregate bond index up 1.3%. There's definitely some volatility in 2024. Experienced some bumps along the way from macroeconomic risks in the presidential election. So, Michelle, another year, another bull market, or at least the continuation of it. Looks to me like tech is still leading the way. However, we live in a tech-driven world, so I'm not surprised if that would be the case. Can you give us a bit more detail on where these are coming from and broader market performance?
Sure. Yeah. So as Dominic mentioned, the S&P 500 ended 2024 with an impressive 23% return, achieving its first back-to-back years of returns over 20% since 1998. The fourth quarter started out strong as equities rallied, fueled by investor optimism following Donald Trump's presidential victory and the Republican red sweep of Congress. Expectations for deregulation, corporate tax cuts, and infrastructure boosted sentiment, though the rally was fairly narrow. It was led by communication services, information, and consumer discretionary, which pretty much led all year. The market's enthusiasm did fade somewhat into the end of the quarter as the Federal Reserve adopted a more hawkish tone at its December meeting. The committee did go ahead and cut rates by 25 basis points, but they tempered their outlook for cuts in 2025 based on concerns for potentially stickier inflation. Still, it was a great year, with the top-performing S&P sectors being communication services up 39%, information technology up 36%, consumer discretionary up 29%, financials up 28%, and utilities at plus 20%. Communication services surged, driven by heavyweights Meta and Google. Digital advertising revenues, which make up the vast majority of the company's total revenues, fueled returns thanks to strong consumer spending in 2024. U.S. ad spending reached $379 billion, rising 9% over the year. In the information technology sector, giants NVIDIA and Apple saw their stock prices soar 171% and 33% respectively. Meanwhile, chipmaker Broadcom achieved triple-digit returns driven by demand for custom AI chips. With one of the lowest price-to-earnings ratios across the S&P 500 sectors, financials also did well towards the end of 2024. The combination of interest rate cuts and Trump's re-election boosted bank stocks, as lower interest rates tend to increase lending activity. And looking ahead, lower capital requirements and in particular deregulation could further support this sector. With 21.1% returns, utilities also had a good year amid electricity demand for what else? AI hyperscalers. Electricity giant Vistra stood out as the top performing stock in the S&P 500 with a stunning 258% gain, and that's thanks to its role in powering AI data centers. By contrast, materials was the only sector to see negative returns in 2024, mostly weighed down by China's economic slowdown.
All right, so I'm going to pause here for a quick market observation and comment. Markets go higher two different ways. Either multiples expand or profit margins expand. The first reflects exuberance for future growth, meaning investors are willing to pay more now for much more later. And the second means companies are earning more and more. So the stock price is reflective of a company being more productive and not solely growing. I like both, and I think we'll continue to see that, especially with the efficiency coming from the technological advances, but we'll get more to that in AI later. My point here, though, is that these last two charts show me that profit margins are expanding. Companies are keeping more of every dollar they make, and at the same time, they're also growing their market share. And who's reaping the benefits of that the most? It's the most efficient companies. And surprise, surprise, even with all the comments around concentration in the market, that's the Magnificent Seven, who's continued to dominate market returns and likely will. So that concentration continues to be touted as a major risk. I know I've said this before, I just don't believe it is. And I don't think anybody really should be losing sleep over it. These companies are becoming more efficient. And if anything, the pack is going to start taking note, learning some lessons, and probably doing the same. And that's what leads to healthy market breadth, with these dominant players continuing to lead the way.
Yeah, and just to add to that, when the last of the earnings reports come in 2024, we're right in the middle of it right now, earnings season, S&P 500 earnings are expected to have grown 9% for 2024. And analysts are projecting even stronger growth of 15% and 13% in 2025 and 2026. So compared to the long-term average of 7.5%, these estimates are quite good. So a trend like nominal GDP growth combined with more stimulative fiscal policy and increasing margins through productivity should support solid earnings gains. As Dominic noted, in the past couple of years, the Magnificent Seven mostly drove the market with earnings that grew by 31% in 2023 and 36% in 2024. Earnings for the rest of the S&P 500 actually contracted by 4% in 2023 and then grew by just 3% last year, hence the higher market multiples. We expect that 2025 might finally bring that much anticipated broadening. Mag 7 EPS growth is expected to decelerate, but with really still strong earnings at 21%, while EPS growth for the rest accelerates to 13%. With this greater earnings breadth, should come greater market participation. 2025 leadership could be less narrow, with opportunities for the left out sectors to also do well. Additionally, Dominic talked about productivity, and I just wanted to circle back to that. Productivity has the potential to be a big boost to earnings in coming years. Positive productivity shocks are pretty rare. However, some of the factors that historically have driven productivity improvements seem to be in place today. Both labor and non-labor input costs have surged higher. So businesses are looking for ways to deliver the same output levels without hurting profitability. In addition to capital and intellectual property investment, having paved the way for significant progress on AI and other technologies, they have a high capital and low labor intensity, and thus leading to higher productivity growth outcomes.
So I guess the year of efficiency, just nod to Mark Zuckerberg, which started in 2022, is still full steam ahead, Michelle. All right, so that's the market. We know that there tends to be some disconnect between the market and the economy from time to time. So Michelle, can you tell us what's going on in the economy?
Yeah, so despite uncertainty stemming from the US election, shifting monetary policy, and heightened geopolitical tensions, 2024 proved to be an impressive year for the economy, with real GDP growing at an above trend pace for the fourth consecutive year. The US economy was quite resilient, supported by a healthy consumer, benefiting from solid household wealth and many consecutive months of positive year over year wage gains. Consumer spending, which is about 2/3 of GDP, powered the economy forward, contributing 2.5 percentage points to the 3.1% increase in real GDP in the third quarter. Other segments have also performed well. Despite higher borrowing costs, business investment has been buoyed by strong corporate balance sheets and fiscal support, while government spending has remained solid. On the other hand, home building has remained subdued due to elevated mortgage rates, and the combination of a strong dollar and sluggish global economy has weighed on the US trade balance. Though there is uncertainty for 2025 around the new administration's proposed policies, particularly tariffs and immigration, and their potential impacts on inflation, we still believe the path for interest rates is probably lower. And as activity in interest rate sensitive sectors normalizes and consumer spending settles at a more moderate pace, 2025 should be another year of expansion, likely, near trend like pace. So taking a look at labor, after rising during the first half of 2024, the unemployment rate has stabilized. At 4.1% in November, unemployment is meaningfully above its cycle low of 3.4%, which was set in April of 2023. That said, it's still lower than it's been almost 88% of the time over the last 50 years. In 2025, steady economic growth should support continued job gains, reducing the risk of any meaningful rise in unemployment. In fact, should labor force growth slow due to more restrictive immigration policies, unemployment might even move lower over the course of the year. So speaking of immigration, big topic, the labor market has normalized from its post-pandemic boom, but looking through recent distortions from strikes and hurricanes, job growth has settled into a relatively healthy pace. That said, the Trump administration has expressed its intent to take a tougher stance on immigration, which could have meaningful implications for the labor market in 2025 and beyond. After falling sharply during the pandemic, labor supply in the US staged an impressive recovery over the last 2 years, largely due to immigration. In fact, CBO estimates suggest that immigration accounted for over 80% of total population growth in recent years. With this surge in the migrant population and workers, employers were able to fill the massive post-COVID spike in job openings you see in the chart here to the left, without applying upward pressure to wages, helping to explain why strong job creation hasn't really sparked a lot of higher inflation, in the wage section anyway. However, if immigration were to be significantly restricted, it could hinder labor force growth, especially given weak domestic demographics and an aging population in the US, and potentially lead to higher inflation through higher wages. So as we've mentioned, consumption makes up nearly 2/3 of the US GDP, so the health of the consumer is key. Dominic, what are you seeing there?
Yeah, so taking a look at the consumer, reoccurring theme I've discussed is there tends to be a tale of two consumers. There's how the consumer feels, which is now and considered the vibe indicator, and there is what the consumer is actually doing, which would be how they're spending, how they're saving, how they're investing, etc. What are they doing with their money? First, how's the consumer feeling? As we can see on the slide here, we have better consumer confidence, and that trend continues to move up, but it's still below the historical average, as you see. I'm not sure if we'll ever really get back to the long-term average. I think some of the surveys that feed this data are a bit flawed, and we have more and more economic and financial media, in my opinion, that perpetuates some dread. But for now, we're heading in the right direction. And, why are we heading in the right direction? Well, wages have continued to rise. And even though that pace is slowed, they're still growing. You also have inflation moderating. So you combine that with incomes going up, the consumer probably sees a rosier picture when they look at their pocketbook. Costs are still elevated. We continue to see that. And it's not going to change probably. But their income is able to cover their spending. And a lot of consumers have seen significant asset growth for those that own assets. So looking forward, I think that trend only continues for the time being. And that's compounded with renewed animal spirits in the financial markets, which we'll go in a little bit more depth shortly. So now, what is the consumer doing? Well, as usual, the good old US consumer is spending and spending and spending. 2024 holiday sales were just shy of $1 trillion. That's up from $950 billion the year before. So spending is certainly not slowing down. More importantly, let's take a look at the consumer's balance sheet. If we look at the balance sheet, it's still extremely healthy in my opinion, and has actually continued to improve as of late. Consumer on the whole, as you see here, is not over leveraged. If you look at the bottom left side of the chart there, liabilities make up about 10% of consumer balance sheets, and those liabilities are predominantly tied to mortgages. That would be the good kind of liabilities versus consumer debt, for example. So why is this healthy? Well, it's an asset that's also appreciating, and you want assets backing those liabilities. Next, if we look at the top right, how is the consumer faring when it comes to paying for these liabilities? Well, the household debt service ratio, as you can see, tells us somebody's disposable income they're going to spend on these debt payments to cover that. As we see on the top right, it's currently at 11.2%. And if we look back at the past 45 years, we're still below the average and the pre-COVID trend line by a significant amount. Lastly, let's take a look at defaults. And there's good news here versus what we looked at the last few times. Car and credit card delinquencies have started to plateau. The past few quarters, we saw this trend start to tick up and pretty fast. It never reached levels outside the norm, which is a good sign. And gladly, that trend hasn't continued. Student loan delinquencies are still at historic lows. Mortgage loans, however, is something I'll point out that has continued to rise. Still not at historical levels, but it's still trending higher. My best guess here is you have some families that stretched in regard to a home budget during very tight real estate inventory the past 2 years and assumed they could also refinance, and mortgage rates really haven't dropped yet, even though the Fed is cutting rates. So I would start to pay more attention and focus on this early indication of some stress in the economy. But at this point, still, I don't believe it's a red flag by any means. I think in the past, we really haven't mentioned the importance of this data. So just wanted to say why we watch these trends. As we said time and again, and Michelle mentioned, 2/3 of the GDP comes from consumer spending. As the consumer goes, so does the economy. So if the consumer's not healthy, it can be an early predictor of why we see stress in the markets or an early indicator of recession. If consumers can't cover their debt or it becomes too high of a proportion of their disposable income, then guess what? They're not going to continue spending on goods and services, and we'll see a pullback altogether. So speaking of spending, Michelle, can you give us an update where we're at on inflation?
Yeah, sure. So inflation made meaningful progress towards the Federal Reserve's 2% target in 2024, allowing the Fed to kick off its rate cutting cycle. However, as you mentioned, Dominic, the downward momentum waned in the fourth quarter, sparking some fears that the progress in inflation had stalled. Headline CPI rose 2.9% year over year for December, compared to 2.4% just 3 months prior. However, gains late in the year were largely due to base effects and with little evidence that price pressures are building. The key driver of the most recent inflation was shelter, of course, which is over 1/3 of the CPI basket, and auto insurance. Though both of these have been a little sticky, real-time data does continue to point to an easing in the price pressures in both of these categories. All else equal, we believe that inflation trends will continue lower in 2025, with the caveat that certain policies discussed by the incoming administration, should they be implemented as communicated, could cause progress on inflation to stall, at least temporarily.
Yeah, my only interjection here, Michelle, this time around would be that I agree some of these policies could be inflationary, and they likely will be if they're implemented, but they definitely should be more one-time shots in the arm versus anything sustained. We've also had some good news recently. As of yesterday, Fed Chair Powell was speaking to owner's equivalent rent, something that we've talked about before, and the fact that it's coming down. I would like to remind everyone that the Fed's data they use lags by about a year. And the Fed gauge operates on that lag versus real-time data, which we've been seeing coming down for a year. So it's good to see that acknowledged and starting to catch up. Speaking of administration initiatives, Michelle, I'm hearing about tariffs every single day since November. What's your take on the potential for tariffs?
Yeah, so over time, economic globalization has led to increasingly relaxed trade policies. The average tariff rate on the U.S. goods imports has steadily fallen since the 1930s. However, geopolitical tensions and supply chain snarls introduced, during the COVID-19 situation have, prompted a reevaluation of open trade policies. With promises to protect American business and address unfair trade practices, tariffs sit at the center of the Trump administration's policy agenda. Admittedly, U.S. trade policy remains highly uncertain, and it's pretty unclear whether tariff policies will be implemented as proposed. It is also unclear whether they will be implemented permanently or just used primarily as a negotiation tool. Regardless, tariffs are likely to rise under the incoming administration. However, the good news about tariffs is, Dominic mentioned this already, they tend to be a one-time move higher in price that doesn't impact future rates of inflation. Thus, inflationary pressures from tariffs will likely be temporary.
Yeah, just to reiterate, again, I think the worst case scenario here is one-time pops. I personally think it's most likely some economic saber rattling like we saw in the first Trump administration. But we'll get to more of this headline risk or rhetoric volatility that's likely to come a little bit later.
Yeah, so speaking of uncertainty and volatility in rates, Dominic, what are you seeing in the bond curve?
Yeah, so interest rates, probably my favorite subject besides private investments. My best friend and everybody's best friend, the 10-year Treasury, feels like it's been all over the place this year, and it's kind of had a mind of its own. Most recently with some meteoric rises, even when the Fed's been cutting, which sounds counterintuitive. So what's really going on here? Well, let's back up to 2024. Reminder, the 10-year Treasury is essentially the gauge for all interest rates when it's being spoke to. Broad sense, when investors are asking what interest rates are doing, the first stop is the 10-year Treasury. It's a benchmark for a lot of other financial instruments, whether that's investing in fixed income or you're actually the one taking out a loan. So 10-year started the year just under 4%. It climbs to 4 3/4 quite quickly, and then it begins a slow and steady march down to 3.6. This comes on the heels of the dovish Fed posturing. You have slowing inflation, and then ultimately you actually have the Fed cutting rates. Then the honeymoon is over, and quite abruptly. All that reverses, and within the next 3 months, it's right back to 4.75%. 1% move may not seem volatile, but if you look on a relative basis, those are 20 to 25% moves. And for interest rates, that's highly significant. So why the reversal? The Fed's cutting. Why is the 10-year rising? Another reminder, the Fed controls the short end of the curve, the left side of the chart you see. Anyone with a money market fund or savings account, if you've checked what you're yielding lately, it's started to fall. So those rates are pegged to that short end of the curve. The intermediate and long-term rate curve, the 10-year and beyond, is largely dictated by longer-term expectations of inflation and growth. You could point to a couple reasons here. There's a reluctance to address the national debt between September to November. Either party and candidate did not have a policy in place to address the debt or the deficit for that matter. The debt continues to rise, our liabilities grow, and our credit rating could deteriorate, demanding higher interest rates for borrowing. You also have increased growth from campaign promises, again, on both sides at that time. Multiple initiatives promised by both sides or that would be stimulative and risk inflation returning. Then lastly, you have the fear of missing out trade. You had institutional investors positioning for upwards of 2 years for a recession. Everyone was calling one in 2023. It never came. It then gets delayed to 2024. At this point, you have a lot of investors starting to feel that fear of missing out and the market's resiliency. If you have people selling treasuries, that's fewer buyers. You already have fewer buyers. Yields continue to rise. My best guess, it's a little bit of all of this, but most likely a considerable amount of that fear of missing out trade. And anyone who knows how yields trade on a daily basis, it's pretty speculative without that much science. One certainty is what happened yesterday. The Fed kept rates as is, and there's really been so far no reaction in the 10-year. It seems like they'll be keeping an eye on the executive policy. Even though they've been largely data dependent, I think it will start to play a lot more into their forecast and decision making going forward.
Yeah, so given all the dynamics we've discussed, weighing the potential for productivity to bring inflation lower versus some concerns around the new administration's policies boosting inflation, at least temporarily, what opportunities do you see in bonds?
Yeah, I mean, not only do I think there are great opportunities in bonds, I think it's only gotten better recently. Or it at least looks easier to extend duration or invest further out on the curve at this point than the last few times we checked in on the bond market. The yield curve has been inverted for almost 2 years. That means yields on the shorter term bonds on the left side here were higher than yields on longer term bonds. If you're going to loan somebody money for a longer period of time, you typically are going to ask for a higher interest rate because there's more risk. So that inversion tells us that you should demand more for it. So when there's an inversion, you assume something in the short term is causing concern, like a recession. Anyways, when the Fed started to cut rates in August and September, yields had started to fall, and it didn't look as appealing to extend duration and lock in those higher rates compared to where the money market was. But if you stayed in that money market or a short-term investment, your rates continued to fall. And now with the recent jump in the 10-year and the uninversion of the curve, it's mentally easier to accept a higher rate further out and buying longer dated bonds. So I think you have more opportunity. It's also given you some built-in protection if yields happen to climb higher. Although I think that's unlikely, it's still a benefit. I think bonds are still a buy. And in fact, if you look into the corporate market, you might see some pretty tight spreads, meaning the trade-off for the risk in a corporation versus a treasury isn't as substantial as it might have been in the past. You have some of the highest underwriting standards that you've ever seen in history in the corporate space and even in the high yield space.
Yeah, I'd just like to add on to that. You mentioned high yield. We really do like high yield bonds right now for a variety of reasons. But corporate fundamentals are strong relative to historical levels. Leverage continues to sit below historical averages, while interest coverage ratios remain above average. Credit ratings upgrades are outpacing downgrades, and valuations remain favorable with yields above 7%. Kind of the best yields we've seen since the global financial crisis. So the net result is the composition of the high yield market remains close to the highest quality since inception.
For sure, yeah. I know bonds are not everyone's cup of tea and can be downright boring. So let's talk about the enthusiasm going on in the market right now. The animal spirits are back, as they say. Just starting at the end of last year, on the heels of the election results, you could see investor and market sentiment start to change. Financial institutions and fund managers really made it clear that they're ready to get back to deal making. And with the new administration come promises for a few things: lower regulation, easier bank standards, less friction, less red tape, and overall a very pro-business sentiment. Regardless of your party affiliation, it's been pretty obvious that executives and bank leaders are really excited and ready to play ball to get deals done. Banks have started to prep investment banking teams, prepping for IPOs. Larger corporations are looking at acquisitions and mergers that they can execute on at this time. And private equity funds, as we've seen, are chomping at the bit to start exiting deals that they've been sitting on. So, Michelle, the spirit's in the air. What's your take on this, and how's it going to affect the market and the economy?
Yeah, so business owners tend to lean conservatively, favoring policies that promote economic growth, reduce regulations, and tax cuts. So not really surprising, since the election, the NFIB Small Business Confidence Index has surged from some of the lowest readings on record to some of the highest. Greater confidence can lead to, of course, increased CapEx spending, which is generally good for technology and infrastructure companies. In turn, increased confidence can lead to employment and wage growth, which is always important for the consumer, with that 2/3 part of GDP and discretionary spending. We looked at this slide last time on AI adoption, but I think it's important to remember that while all this infrastructure spend right now is helping the hardware and the picks and shovel businesses, very soon we will be, expecting to move into other sectors, and they will be benefited as they move towards more corporate application and adoption. In the bottom right of this chart, you can see the AI adopters today who will be benefiting from their margin-enhancing investments in the future. These sectors include professional and technical services, educational services, finance and insurance companies, and healthcare, among many others. Dominic, you also touched on M&A, and for the many reasons you mentioned, M&A is expected to increase in 2025. M&A helps organizations expand into new markets, diversify business activities, and achieve cost synergies through economies of scale, so more productivity. M&A and IPOs both mean more business for financial institutions. Lending in both the private and the public markets should increase in 2025, driving returns for banks and alternative asset managers. In the private markets, M&A should bolster private credit issuance in its expanding role as the financing source for situations requiring, flexibility, certainty of execution, confidentiality, customization, and partnership with fewer lenders. In private equity, investors are really eyeing the end to the IPO drought. The long period of low interest rates following the GFC led to many companies remaining private for longer, even when they became very large. We believe one of the biggest areas of opportunity in private equity is in the large private companies, ideally at attractive valuations that are not yet public.
So sticking on the theme of animal spirits and the enthusiasm, timely event, the president announced a fairly sizable AI-related package last week. And it sounds like I think there's some infrastructure implications as well. Michelle, can you tell us a bit more about that package that's in the works and who's it going to benefit?
Yeah, so 3 top tech moguls alongside the president announced that they will create a new private business venture called Stargate to grow artificial intelligence infrastructure in the United States. So OpenAI CEO Sam Altman, SoftBank CEO Masa Son, and Oracle Chairman Larry Ellison appeared at the White House alongside, of course, President Trump to announce the venture, which Trump called the largest AI infrastructure project in history. The companies will invest $100 billion in the project to start, with plans to pour up to $500 billion into Stargate in the coming years. The project is expected to create 100,000 US jobs. Trump said Stargate will build the physical and virtual infrastructure to power the next generation of AI, including data centers around the country. Ellison said the group's first 1 million square foot data project is already under construction in Texas. AI leaders have for months been sounding the alarm that more data centers, as well as the chips and electricity and water resources to run them, are needed to power their artificial intelligence ambitions in the coming years. This infusion of infrastructure spend, of course, will benefit many companies and sectors, including power providers, data center infrastructure plays, optical networking companies, data center REITs, memory suppliers, semiconductor and semi-equipment makers, and many, many more.
So speaking of semiconductors, happy to address the elephant in the room. We had quite a bit of volatility in the market to start the week with semiconductors and really anything AI adjacent taking a pretty big hit following a newly hyped AI product coming out of China. And without naming names or speculating too much, I'm just going to say at this point, it's a definition of a robust overreaction. So far, we don't have any fundamental driver here that we really know of yet. And a majority of the selling we saw was driven and exacerbated by leverage trading and leverage trading vehicles. So my best guess at this point, for those who remember July and August, this will be a yen carry trade 2.0. But we're still finding out in real time with tech companies reporting as we speak, like Meta yesterday. And it gives us insight into their CapEx spending that is not predicted to stall at all in regards to this AI spending. That would relate to semis and data centers going forward. So speaking of volatility, headlines and rhetoric risk. With the new administration, it's quite clear there's going to be a considerable amount of pointed statements about the economy as a whole or specific companies. We've done and seen this before in President Trump's first term. And whether the interpretation of those statements is good or bad, positive or negative, just going to warn everybody that trying to get ahead of a trade or a potential policy change without any certainty or just based on a headline is a losing proposition. I would say most of what we initially hear might move markets, but the eventual impact we see is really anyone's guess. And until we have the fundamental information, a lot of it tends not to come to fruition in reality. And I'm not going to underestimate the volatility. I know some of it's concerning at times. So if you really cannot stomach the volatility in the markets, there's always less volatile asset classes, even if the longer term trend is up. So if you can't sleep at night because of the volatility alone, then consider a change in the allocation and how that's going to affect your planning expectations. I think that's the best approach at this time if it's really concerning for you. All right. My favorite discussion topic, Michelle, private investments. So let's start out by talking why, again, investors might want to look to private markets.
Yeah, so with all of the uncertainty that's out there, investors who are willing to venture outside of the public markets can leverage a range of different private assets to diversify their portfolios and reach their desired outcomes. As you can see on this next slide, alternative assets can offer low correlations to public markets, diversified income streams, and enhanced long-run returns. Real assets shown towards the left, such as real estate, infrastructure, and transport, tend to be less correlated to a traditional 60-40 portfolio while providing robust income. Private equity and venture capital towards the right can provide higher total returns, but come with higher correlations to public markets and less income generation. The classic 60-40 bond portfolio still looks attractive, but adding a sleeve of alternatives can help long-term investors achieve strategic goals through higher alpha, better diversification, and enhanced income.
Just a reminder, my role as an advisor working with clients, I just need to reiterate, private investments are certainly an opportunity and a tool one can use in their portfolio to provide some of the benefits Michelle just mentioned. But this does require proper liquidity planning, assessing one's risk tolerance, understanding how to allocate to these more complex investments, and how these differ from public portfolios. These additional benefits come with different risks. So working with an advisor and a team that has experience in these types of investments is paramount. All right, my PSA is over. So let's talk a little bit more about the asset classes in private markets that we like right now.
Yeah, so we continue to like private credit. It's a great diversifier and a hedge against inflation because companies generally pay coupon interest on a floating rate basis. When partnering with an experienced GP, strong due diligence combined with high quality loans in the senior secured portion of the stack offers stable income, low historical default rates and volatility, which translates to solid risk-adjusted returns. Infrastructure continues to be a favorite due to the many themes we mentioned earlier, like the build out of data centers and the need for power to run them. Core infrastructure investments tend to be in the central services area, like utilities and contracted power assets, which often operate on a monopolistic basis, either by regulatory structure or long-term contract, which drives real solid visibility into EBITDA and cash yield. As such, infrastructure is less sensitive to economic cycles, while it provides cash yield, diversification, and a hedge against inflation. And sticking with real assets, real estate is starting to stabilize and looks positively positioned for 2025, given a less onerous interest rate backdrop. We would still be avoiding office, but believe other parts of the real estate market are positioned for structural growth. This includes data centers, so i.e. demand related to artificial intelligence, industrials, for the growth in e-commerce, healthcare, which is all about the aging population and demographics, and residential, which continues to have a shortage of housing. Private equity continues to be interesting. While many fund managers have elected to hold their prized assets until the exit environment improves, the value of these portfolio companies continues to appreciate, driven by strong profit growth across their portfolios. We do expect that exit activity will increase meaningfully now that the election is behind us and the cadence of interest rate reductions is finally underway. And given the low levels of liquidity in the private markets over the past few years, we believe the secondary private equity market continues to be an interesting way to get access to high quality companies at a discount.
Yeah, so a couple thoughts on these different private asset classes to add on to what Michelle said. I think private credit's a great core piece to any private portfolio. You're seeing a substantially higher return than you would for public bonds or public credit instruments. Obviously, with more liquidity, my best advice here would be make sure you're working with a strong general partner or asset manager to make sure that they have experience in this space. One of the benefits in private credit is those loans don't get syndicated, meaning the manager continues to work with those companies throughout the lifespan of that loan. So if there are any risks associated with it, they're there, as opposed to that being sent off to hundreds of thousands of different investors, for example. I think infrastructure is a newer asset class, Michelle, and I think it's a great opportunity for more stable cash flows. And I think the more growth the areas of that, with all these stimulative benefits that are coming from even the previous administration and now the new administration, there's a lot of money to be spent on infrastructure, whether it's newer AI related items or even our existing roads, bridges, and tunnels that need a lot of improvement and have been somewhat ignored, regardless of parties over the past probably 5 to 6 administrations. Real estate, I think, is a good opportunity, and I think that's why we're specifically looking at that market now. We've seen a lot of price contraction, and I think things are starting to look quite appealing. And I think private equity always offer opportunities, another space where you really want to make sure you're working with an experienced manager that knows their space and has resources. I think overall, there's been some concerns about private markets being more commoditized or having too much money chasing fewer opportunities or assets. If anything, the data is starting to show us that the alpha from private markets is actually just as good as it's been in the past, and it's actually picked up a bit as long as you're working with quality managers. So manager selection is absolutely paramount in this space. Knowing the people to work with, their expertise, how they're investing and why they're investing, I think, is one of the ways to mitigate a lot of risk and continue to generate those additional returns that you don't always see in public markets. So with that, I think we're coming to a close on our prepared slides and commentary for the day. We appreciate everyone joining us. I think we have 1 or 2 questions with the 1 minute we have left, so maybe we'll try to squeeze one in here. Let's see, timely one in regards to what we discussed earlier about volatility. So bubble in technology is the question, and I think this might refer to NVIDIA, Michelle, or maybe some other areas of the tech market. Any thoughts on a possible bubble in the tech sector?
Yeah, I mean, there's a lot of talk about market concentration, and that does, generally mean lower diversification and higher risk. But the current market looks nothing like that of the dot-com bubble. Today, the biggest technology companies have the highest earnings growth. We talked about that earlier, profit margins, capital expenditures, and free cash flow generation in all of the S&P 500 index. And unlike the dot-com bubble, I mean, this AI cycle has been driven by a surge in earnings rather than by a bunch of hype and speculation. So as an example, back in March of 2000, technology giant Cisco was one of the most, darling of all stocks on the US equity markets, with a next 12-month price to earnings ratio of more than 125 times. So by contrast, NVIDIA's PE is currently around, well, it says here 32 times, so it's probably closer to 30 times after this week. But Wall Street's estimates for NVIDIA's full year 2026 earnings have increased from, get this, 62 cents in November of 2022 to $4.07 at the end of September last year, meaning that NVIDIA's 7-fold share price increase was almost entirely driven by earnings growth rather than market sentiment. So I just don't think the bubble speculation is really very valid.
I think the major difference, whether it's NVIDIA or other companies, is there are earnings. The market, the dot-com market of 99, 2000, 2001, revolved around a lot of companies that couldn't have a PE because there was no E. So it's definitely drastically different this time. So if there's other questions, we'll be happy to answer them after we close out here. Feel free to email us any other additional questions. But with that, we're at time, so I'll hand it over to our marketing team here to close us out.
Awesome. Thank you, Michelle and Dominic, for a great presentation today. If we didn't have time to answer your questions, we will do our best to follow up with you after the webcast. Here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Please also visit mossadams.com for future webcasts and other resources to help elevate our performance upward. Thank you for joining us, and we hope you'll join us again next time.
Thank you.